I'm sure you've watched the movie The Big Short, or at least read the book, and you know who Michael Burry is. If you watched the movie, I did not read the book, but I watched the movie. It's a great movie. I highly recommend it. You should watch it if you are an investor. So Michael Burry is a character in that movie. The movie is a real life story, so it really happened like that. And he was one of the first persons to actually discover that there was a bubble in the housing market in the 2008-2007 period. And he shorted the housing market.
The housing market is propped up on these bad loans. It's a time bomb, and I want to short it.
At the time, people were laughing at him. There is a scene where he goes to Goldman Sachs and tells them that he's going to short the market, the housing market, for $100 million, and they laugh at him. He tells them that can they guarantee that if anything happened to Goldman Sachs, they will pay him for his investments, and they laugh at him, and they take the bait, and eventually he wins.
Excuse me, Dr. Burry, it seems like a foolish investment.
Based on prevailing sentiment of the market, banks, and popular culture, yes, it's a foolish investment, but everyone's wrong.
That's a good one.
This is Wall Street, Dr. Burry. If you offer us free money, we are going to take it.
My one concern is that when the bonds fail, I want to be certain of payment in case of solvency issues with your bank.
I'm sorry, are you for real? You want to bet against the housing market and you're worried we won't pay you.
Yes, that's correct.
And today he's telling us that there is a new bubble. That bubble is in passive investing. What actually is passive investing? If you are a passive investor, it means you're not actively looking for investments. Let's say I'm not sure about my investment skills, but I have money to invest. I want to invest in the stock market. What can I do? Instead of looking for stocks, I don't have the time to look for stocks. I can invest in an index fund. I always tell you that the best thing you can do if you are a complete beginner is to invest in an index fund. Now, as you progress, you can look for ETFs. And as you progress further, you look for mutual funds. And then most probably, if you want to be an active investor, now you look for individual stocks. This is the best thing that any individual can do. So far so good. It seems that index funds are a great thing, and they are a great thing. They give the opportunity to everyone to invest. This is the best thing in the history of the democratization of finance, the introduction of index funds. But the problem with index funds and all these ETFs is that now there are too many people investing in them. And when you invest in an index fund, let's say this index fund, the S&P 500 index fund, which is run by Vanguard, what you're actually doing, you're investing in Vanguard. And Vanguard is going to buy those shares for you, but they will keep it in their name. So you don't own those shares. Let's say you invest in the Nasdaq 100 index fund, the one run by Vanguard. 10% of that index fund is Apple. You don't actually own any shares of Apple. It's Vanguard which owns the shares of Apple. And today when you look at the amount of money these companies, the one who runs the index fund and ETF and other mutual funds have, the amount of assets under management, it's unbelievable. Vanguard Group currently has $5.3 trillion in assets under management. BlackRock has 6.8 trillion and State Street has 2.5 trillion. So these three companies, they are the ones owning most of the indices, most of the companies in the S&P 500, most of these big companies. Let's take for example Apple. If you go on Yahoo Finance, you can find the holders of Apple, the top holders of Apple, and you will see something interesting there. That 61% of the shares of Apple are owned by institutions, so it's not individual investors like you and me. Another interesting thing is that 7.42% is owned by Vanguard Group, 6.23% is owned by BlackRock, Berkshire Hathaway 5.52%, State Street 4.14%. So out of these four top holders of Apple, all four of them are institutions. Berkshire Hathaway is the only active investor in that. So you see, most of those big companies are owned, a huge amount of their shares are owned by passive investors, and this is a problem. The problem is that passive investors don't vote. So if Vanguard Group owns 7.42% of Apple today, when there is a board meeting, they have to choose for board members. Vanguard Group is not supposed to vote. They are not going to vote for the board members. So 7.4% of the voting rights of Apple is useless. It's not that there's 7.4% actually. You have to account for BlackRock and State Street and also all the other index funds. All of these you have to account for. If you go a little down in that page, you can also see the top mutual fund holders. The Vanguard Total Stock Market Index Funds is 2.52% of Apple. The Vanguard 500 Index Fund 1.89%. The SPD or S&P 500 ETF Trust 1.06%. Also Invesco, Fidelity, all these companies, they make index funds, they make ETFs. If you are going to buy these ETF and index funds, you are a passive investor without any voting rights in those companies which you are actually owning indirectly, because you are an indirect owner. So let's say I am an owner of Apple, an active owner. Let's say Warren Buffett, Berkshire Hathaway, they own 5% of Apple. So they have 5% voting rights. But now there is one company, Vanguard Group, which has more voting rights on them, but they are not going to execute those rights. So you see the problem with that. If 30% of a company is owned by non-voting members, it's hard for you now to make your decisions as an active shareholder go into the board of directors. It's hard for you to get elected to the board of directors. When Tim Cook defended the policy of share buyback, telling that it benefits 50% of Americans, it's not because 50% of Americans own Apple shares. It's because indirectly 50% of American people, they actually have some ownership of Apple shares indirectly. Maybe it's in the pension funds. Those pension funds, they own index funds. It's likely they invest in ETFs. That's why 50% are directly affected. So you may say you are not interested in the voting rights. You just want to make money investing in the stock market. So it's easier for you to go in an index fund. What is the problem with that? The problem is that now so many people are buying those big companies. So many people want to invest passively, and those index funds, they mostly buy big companies, that there is a bubble in those big companies. Now let's say there is a bear market coming. Those people are going to sell those shares, those index funds, those ETFs. And when they begin selling, Vanguard Group also has to sell, because otherwise they will lose money. So they also will sell their shares of Apple, and when they sell the shares of Apple price go down. And when Apple prices go down, what happens? Algorithmic trading. The algorithm says that there should be more trading, more selling of Apple shares, and it keeps going down. That's why you saw last year there has been such a massive volatility in Apple shares, in Amazon, in Facebook, all these big companies. It's mostly the big companies which are volatile. What can you do about it as an investor? The best thing to do, according to Michael Burry, is to buy small companies. That's also one thing I told you. It's better now to buy smaller companies compared to big ones. I know what you may be thinking. The top 3 companies in my portfolio are Apple, Facebook, and JP Morgan Chase. 25% of my portfolio are companies with more than $350 billion in market capitalization each. Apple is nearly $1 trillion company. Facebook 500 billion. JP Morgan Chase 350 billion. So why I own those big companies? It's because I bought them a long time ago. And now when I'm thinking about what Michael Burry is saying, it's not just because what he's saying. I've been thinking of this for a long time. I think that it's time to diversify away from these companies. It's not because I don't believe in these companies long term. But the time when I invested in those companies, I already made some profits. And gradually, I want to trim my positions in these companies. It's not, I'm not telling you that I'm going to sell Apple. I don't think I want to sell Apple. It's always going to be number 1 on my portfolio for the upcoming years. But I want to trim some position, take some profits, invest in smaller companies. Because I've been investing in smaller companies recently, in Parsley Energy, in Control Resources, in Skyworks Solutions. You see, it's better to invest in Skyworks Solutions instead of Apple if you want to win from 5G. Skyworks Solutions is smaller, it can grow faster. Smaller companies are always going to grow at a faster rate than bigger ones. I'm not telling you not to invest in big companies, because it will be unfair if I tell you this. I own 3 big companies in my portfolio, even Disney, but it's not that much on my portfolio. But you should be careful because if there is a bear market coming, I don't know when, maybe next year, in 2 years, in 3 years, but it will be coming. You should be prepared if you own a lot of big companies. Let me know in the comments if you own index funds and what are your biggest positions in your company, in your portfolio. Do you own any big companies? Thank you for watching this video. Please like, subscribe and share. Please watch these two videos here if you missed them. Have a nice day and goodbye.